This is Ryan Coombs, Vice President of Research and Strategies at Carty & Company. Here's your weekly market update ending the fourth Friday of April 2016. The number of Americans filing for unemployment benefits unexpectedly fell last week, hitting its lowest level since 1973. This suggests the labor market continued to gain momentum despite weak economic growth. Initial jobless claims for state unemployment benefits declined 6,000 to a seasonally adjusted 247,000 for the week ended April 16th. This is the lowest reading since November of 1973, the Labor Department said on Thursday. The National Association of Realtors has been warning for months that low inventory and rising prices has been slowing sales of existing homes, which make up roughly 90% of the housing market. The U.S. housing market has been in decline since November, and based on data in February, sales fell 7.1%. Next Wednesday morning, the existing home sales for March is released. Real estate brokers from firm Redfin reported a 12% rise in metro area listings in February, meaning a pickup could be on the horizon. On Friday, a Reuters poll of 80 economists consisting of almost all the Wall Street primary dealers forecasted the Federal Reserve will keep interest rates steady at its policy meeting next week. The economists did hold firm on their expectations for a rate hike in June, and then another by the end of this year. About two-thirds of the economists polled expect the Fed to raise its target federal funds range in June by 0.25%. Another 20% said September, with the remainder saying early July or December. Bloomberg's federal funds futures show that only 22% of the market currently anticipates a rate increase in June's meeting. In fixed income, U.S. Treasury yields held near three-week highs on Friday, as investors focused on next week's Federal Reserve meeting. Yields have fallen since the beginning of the year on concerns about weakening U.S. economic growth and rising volatility in the oil and stock markets. This has led investors to lower estimates that further rate hikes are in the near future. Benchmark 10-year notes were last down 2/32 in price, to yield 1.88%, up from 1.87% on Thursday. The yields had held in a tight range between 1.69% and 1.81% from the beginning of April, until breaking above the range on Wednesday afternoon. Using Andrews Pitchfork as a trend channel analysis shows yields on the 10-year notes have resumed the upward channel that began on April 7th, after temporarily forming a lower trend channel that resulted from Janet Yellen's dovish comments about future rate hikes. In stocks, disappointment with earnings sent the NASDAQ 100 stock index towards the steepest drop in 2 weeks. While the tech-heavy NASDAQ slid, gains in crude boosted energy producers, limiting the S&P 500's decline. Technology shares had their biggest slide since February 23rd, with Microsoft and Alphabet down at least 4.9% each. Banks rebounded toward a 3-month high as Norfolk Southern Corp jumped to the most in 5 months as earnings beat estimates. The NASDAQ 100 dropped 1.4% to 4,476, pairing a 2.2% intraday retreat. The S&P 500 rose less than 0.1% to 2091, wiping out a 0.5% decline. The Dow Jones Industrial Average added 23 points to 17,998, erasing an earlier 72-point slide. That sums up your weekly market update ending the fourth Friday of April 2016. For more details, please visit our information center at www.cartyco.com, and for real-time updates, follow us on Twitter at Fixed Incomes. Thanks for watching, and have a great week.